Good morning, everyone. It was largely a technical market overnight. Most of the news was positive for the dollar, or at least negative for the euro, and yet the dollar fell back against most currencies. Seems to me to be just the usual profit taking on the big move that we had on Friday, not the end of the trend by any means. Most attention was focused elsewhere. The stock market rose for the 7th day, VIX volatility fell to a 6-year low, and Treasury yields rose modestly, which shows that confidence in the U.S. economy continues in those markets. That suggests the dollar should regain its poise in the near future, as it's now being buoyed by good news about the U.S. economy. The focus today is likely to be on Britain, where the market's expecting manufacturing production to be unchanged month on month after a strong 1.6% month-on-month rise in December. The UK visible trade deficit is expected to widen further, although the total trade balance is forecast to be unchanged. The pound fell yesterday in anticipation of these data, as the Bank of England is known to want to rebalance the UK economy, meaning to shift it away from consumption and more towards production as a driver of growth. Producing more may mean boosting exports, which would require a lower pound. Sterling may also have been affected by the annual report of the Norwegian Oil Fund, which reported that it sold almost half of its holdings of UK gilts last year as it rebalanced its bond holdings according to the size of the economy, not the size of the bond market, something that could mean less foreign demand for gilts if it becomes widespread. Now, cable has met all our short-term targets recently, and so we revised our charts. We now have a short-term target of 148 the figure for the next 3 sessions, with upside resistance coming at 150 the figure. This is Marshall Gittler, Global Head of FX Strategy at IronFX, wishing you solid trading.